All right, everyone. Welcome, welcome. I'm going to get started here. I wanted to welcome everyone. Thanks for joining me here this Thursday evening for the Midwest First Time Home Buyers class. Don't make these 5 money mistakes when buying your first home. To start, just a little bit of information. The presentation itself is going to cover the mistakes people make when obtaining a mortgage, certain mortgage features that can help you save money. And then at the end, we're going to talk about an option on how you can book times with me to talk a little bit more. Just a few housekeeping items. There is going to be someone watching the chat feature. So if you have any questions, please feel free to use the chat function. At this point, we're just muting everyone. But throughout the meeting, we're going to also have a few breaks throughout the meeting where we're going to be able to answer questions, as well as at the very end of the meeting, we'll also have some more question and answers. A little bit about me. My name is Rob Miller. I'm the branch manager and senior loan officer at Provisor Incorporated. Some compliance information. We have some information up here. Provisor itself is a Wisconsin-based company based here in Wisconsin. Started in 1998 in Madison. My president, James Mercado, who is still the president of our company, is still running everything. Provisor itself, over the last 12 months, we fund just over 1,000 loans a year. We are a little bit smaller of a company. We're not the giant companies that are out there, but we do certainly fund quite a bit of loans. On the screen at the very bottom right-hand corner, you'll see a QR code. Now, if you click your phone up to that and take a picture of that with a QR code, it will take you to a website, which will also give you my contact information. So if you see my contact information on the screen, you can also click on that and save it to your phone. Just wanted to talk about some stuff that I truly believe in. The main skill that you should look for in a mortgage company and a loan officer is their ability to solve problems. Our lives have hurdles. A loan officer's job for you is to guide you through those hurdles and solve problems. And that's the key to obtaining the correct mortgage without spending too much money. First mistake, number one, is not using a lender or a mortgage loan officer who offers all the mortgage options. If you don't have all the mortgage options available to you, you may be overspending, you may have a higher interest rate, you may not even qualify for certain programs. And not having a lender who's going to offer you all the options is definitely something that's going to cause some pain and cost you some money. Different types of loans that we have conventional loans, VA loans, USDA loans, FHA loans. Those are the standard conventional type financing loans, national loans. The number one conventional loan is going to be, have you ever heard of Fannie or Freddie Mac? That's going to be the conventional financing. A lot of local banks offer that, but also national lenders offer that as well. The other three options, VA, USDA, and FHA, those are government-sponsored loan programs. So there are programs that are out there that are actually a little bit less expensive than conventional loans in a lot of cases, that can certainly help you get into it. And as you see, very low down payments, very low credit score requirements. In the state of Wisconsin offers a program called WIDA. WIDA has two different versions of it that they offer. They have a conventional version and they have an FHA version. Conventional version is just like a standard conventional loan, and the FHA is just like an FHA loan. However, with WIDA, because it is a Wisconsin-sponsored program, they also offer a second mortgage option, which can actually help people get into a property with no money down. So as we saw on the previous page, some cases you have to have a little bit of a down payment, whether it's 3 to 5 to 6% down. with WIDA, they offer a second mortgage that kind of piggybacks along with that and allows you to get into it with little to no money down. The other options that are out there are very specialized programs. Non-QM. Non-QM means non-qualified mortgage. These are programs that are going to help people that, to get into a house where maybe you had a recent bankruptcy or you're self-employed and you don't show a lot of income. There are programs out there that are available for you as buyers. And that's something that you want to make sure that your loan officer has and can offer for you, because that might be a better solution for you. Adjustable rate mortgages. That's certainly well talked about these days with interest rates going up. It is something that we're going to see a lot more. Adjustable rate mortgages are going to be fixed for a certain time period, whether it's 3, 5, 7, or 10 years. And then after that period of time, they actually go up a little bit. Jumbo loans. Jumbo loans are the non-conventional loans. So if you are in the situation where you want to find a house and maybe you're looking at a house that's you're going to get a loan on it and it's going to be a $1.5 million home, maybe not. But there are programs out there where you can get into a loan and get into that home when you're above the standard limits, which is listed here at $647,200. Little bit more going on to what are the rules, and then of course what are overlays. So official lending rules are rules that are across the country. Everyone's going to have them. FHA, VA, USDA, Fannie and Freddie are going to have the same rules. However, each individual lender decides their particular risk tolerance, and they can add overlays. And overlays would be an additional thing above and beyond the official lending rules. That's why you might go to a lender and the lender says, oh, no, I can't qualify you. That might be because they have an overlay where your debt to income ratio is too high, or there's something out there that is, something that showing up on your credit report, or you don't have a lot of income history. And so therefore they are going to have an overlay. So, one lender might be different than another lender. So you really want to make sure that you talk to your loan officer if you're working with one, and ask them, what are your overlays? What do you have for overlays? When people go out and buy homes, they're going to go out and buy certain types. And these are the home types that are available. There's single family homes, which are anywhere from a 1-family to a 4-family home. A condominium, where you're buying a property, but maybe not purchasing the land along with the property. An investment property, vacation home, a second home. Maybe you want to get a rental property. So there's a lot of different home types, and you want to make sure that you're working with someone who's going to be able to offer programs that are going to be out there. So if you are out there looking at a particular home, you have the ability to write on that home if you want to. At this point, my first break, does anyone have any questions on this section? Please feel free to put it into the chat window. Answer any questions about what we've gone over so far. Of course, if you don't feel comfortable putting it in chat and spreading it out, you can also give me a call and we can book an appointment. I have a calendar, an online calendar that you can use, and I actually just put it into the chat window as well. So if you want to book a time with me, you certainly feel more than welcome to book a time with me. But if anyone doesn't have any questions, it doesn't look like any questions have come in. So I'll go on to the next mistake. So mistake number 2, ignoring sources available for down payment and fees. This is a big section here. So this is going to talk about, do you have money for down payment? Are there certain sources that you can use? Different sources you have for down payments. Of course, you can use your own money if you have money for down payment. You can get a gift from a family, from friends, from your employer for that down payment. There are some down payment assistance programs out there They either work as a loan, kind of like I talked about before with WIDA. They offer a second mortgage or a second loan. Or there are some other organizations out there that you can get grant money where it's not actually a loan. You don't have to repay it. Of course, if you currently have a home and you're looking to buy another property, you can put a second mortgage on that home in order to get some money for down payment. You can use the proceeds from that sale if you're going to sell the property to buy a new place. You can secure a loan on any asset that you own. Now, you can't go out and get a personal loan or anything like that for down payment. But if you do have a car that you don't owe any money on, or you have an RV or something, you can certainly get a loan on that, and you can use that as down payment money. You can sell that automobile. You can sell, if you have some guitars or you have some artwork or some jewelry, you can sell that stuff. The only thing that you cannot use, and something that you want to make sure of, is you can't use cash money that you just have at home. Unless, of course, you deposit it in your bank account months in advance. Now, months in advance, I'm talking minimum 2+ months. But if you have cash, you want to make sure you get it into the bank as soon as possible and give yourself some time, because we are going to look back on the previous 60 days or 2 months to look at your account to see for down payment purposes. And cash is just not something that's very easily traceable, provable. So we really need to make sure that we're doing that. Some other information, closing costs and prepaids. Closing costs are something that is going to always be there when you buy a home, no matter what you're doing. As well as there's prepaid fees, which is another cost, but it's something that's prepaid on your behalf for the purchase or for the ability to buy the home. So when you buy a home, there's going to be plenty of costs. People hear costs can be $3,000, $6,000, $8,000, and you think that's a lot of money. And you're right, it is a lot of money. But when you understand what each fee does, it's going to make sense why they're charged. It's a silly example, but yet it is an example. When you think about the vast amount of money that you spend out there, one of the biggest things you do is, compare buying a home to going to the grocery store and buying a Snickers bar. If you buy $100,000 home, you're probably going to be close to about $4,500 in closing costs and prepaids. Now think about doing the same thing, buy $100,000 worth of Snickers bars, and then you're going to pay sales tax on that. And that sales tax on $100,000 is $5,500. Obviously means that the cost to buy the Snickers, $100,000 worth of Snickers, which is a lot, costs more than it does to buy a home. What are closing costs? We have a list here of closing costs that you could possibly incur when you buy a home. And there's an appraisal. We have to determine the value of the property. We have to process and underwrite the file, which means we have to pay for someone to review everything, make sure everything meets the lending rules, not necessarily the guidelines, but the lending rules. So we have to have someone look at all the information, your income, your assets, your credit, make sure everything meets the guidelines. There could be a flood certification. So we're going to determine whether or not you're in a floodplain. Potentially there's a credit reporting fee. We might have to verify or do some verification of employment, or if you buy in a condominium questionnaire. Title closing fees. You're going to pay a title company to put together everything and close and sign all the documents at closing. There's a government recording fee. You're going to have to record that you are the owner of the property and that there's a mortgage on it, and there's a fee that they charge for that. Then, of course, there is potential for what they call discount points. Now, discount points are something we'll talk about at a later point. There is potential that there are other fees that are listed here that you may incur. Prepaid fees. Prepaid fees are expenses that are paid in advance from when the money's technically due. So in other words, we're going to need to have homeowners insurance on the property. So we're going to have a fee, or not a fee, but there's going to be a prepaid item for homeowners insurance for the first year. If for some reason you have to, or you're buying a condominium, we're going to make sure that your first month's condominium dues are paid. And then, of course, depending on the day of closing, there's going to be interest that's going to accumulate from the day of closing until the end of the current month. So those are all going to get lumped in. How can you pay these fees? Similar to the down payment options, there's quite a few. You can use your own money. You can use gifts. Again, you can use down payment assistance programs. As well as there's a couple other things that aren't listed here. One's called a seller credit. One's a lender credit. A lender credit is pretty simple. If you take a higher interest rate, then there's going to be potentially a credit that you're going to get based on the loan amount, based on the credit that you're going to get that could offset some of your costs. So that's called the lender credit. Now, of course, you can also go and ask the seller for a credit as well, and they can pay for your closing costs or prepaid items with a seller credit. Usually that happens when you offer on a home and you ask them to put a credit. You're going to offer them a little bit more than it's listed at, or maybe a little bit more than what you feel comfortable offering. And you ask the seller for a couple $1,000 credit. That is something that would go in there, but then that would tack on some loan to your overall loan amount. Does anyone have any questions about the section that we've gone over so far? Please feel free to use the chat window. I'd certainly love to answer any questions that anyone has. If no one doesn't have any questions, give another minute or two here. All right. And please feel free if you want to schedule a time. The calendar link is there. You can certainly schedule a time to talk with me. Just go over some of these things just so you're prepared. My goal here, obviously, today is to just give you some education on some stuff that you want to make sure you're prepared for. Whether you use me or not for financing, I just want to make sure that you understand what's going on and that you can be and feel confident when you go and talk to a lender. And one of the most important things that you're going to want to make sure of is mistake 3. And that's not getting a pre-approval. If you don't get a pre-approval, it's going to be hard to get a loan. It's hard to get an offer accepted on a house. So a pre-approval is something that you're going to get from your lender. And we're going to look at your financial and credit history, your credit report, your income, and any money that you have available. If you've talked to someone already and they have not asked you for pay stubs, W-2s, tax returns, they haven't run your credit report, well, you have not gotten a pre-approval. And a pre-approval is very, very, very important to have, because a pre-approval is going to put all that information together, and then we're going to put it into a software program that we use. And that software program is going to spit back to us whether you're approved to be able to buy a home. The art of being a good loan officer is knowing the software itself and how to utilize it to make sure we can absolutely understand that you're pre-approved. And of course, when you're pre-approved, you're going to feel confident that you're going to know what you can afford. You're going to have a good idea of what your monthly mortgage payment's going to be. So you're not putting an offer on a home and then you're like, oh my gosh, my mortgage payment's way too high. It's also going to help us identify all the different loan programs that we talked of at the very beginning. It's going to help possibly fulfill your needs, maybe give you a lower payment, maybe give you different options that you have that can maybe save you money over the life. And then, of course, you're going to walk away and you're going to get a letter from that lender. And it's going to say that we've looked at all your information and we have sent your information to the software program that we used and you have been pre-approved. So when you go and decide to write on a home, we are now going to be able to make sure that your offer is going to look better to the seller of the property. All sellers, listing agents, some of my real estate friends will tell me, you can't put an offer in on a home, and you really shouldn't be looking at a home unless you are pre-approved. They're going to want to make sure that that is the case. So one of the biggest things that you can help make you feel comfortable and also make sure that you're getting into the right property, the right payment, the right loan program is getting pre-approved. Any questions on this section? Please, again, feel free to shoot me a message here in chat with any questions. There'll be some more time at the end, but at this point, I will go on to mistake number 4. Mistake number 4 is not paying any extra on your mortgage payment each month. This is a huge thing. When you actually get into a home and you get a mortgage, you want to make sure that you are utilizing the mortgage correctly. In the market that we are, with interest rates being higher than maybe they were a year ago, you want to make sure that you are working your mortgage for you so you can get the best savings over the life of your loan. So I'd like to draw attention to column. We have 4 columns here. The top section is all going to be exactly the same. The only difference is, if you look at the last line in white, it's going to show an extra monthly payment. So as you see, option 1 is no extra payment. And then, of course, as you go over to option 4, it's going to show an extra $200 a month. The big things that you're going to see here is option 1, obviously it's a full 30-year mortgage. And then as you go all the way over to option 4, it is going to be, if you pay an extra $200 every month, you're going to pay your mortgage off in a little less than 22 years. And as you go up into the blue section, it's going to show you in the next 10 years how much interest you've paid. The difference is almost $10,000. And then as you go down to the next section in blue, again, the same scenario. You will have saved yourself, your balance on your mortgage is $30,000 less. So if you can figure out a way to make extra payments, it's going to benefit you in interest. You're going to save $10,000 in 10 years. That's $1,000 a year. And that's almost $100 a month. So that's a lot of money extra in your pocket on a monthly basis. Does anyone have any questions on this section? Please feel free to put it in the chat. Otherwise, we'll get to more questions at the end as well. And of course, you can always feel free, click on my calendar link, give me a call, shoot me an email. I'd certainly love to chat with you, just give you some extra insight, maybe go over some stuff. And if anyone's interested at any point with obtaining the PowerPoint presentation that I have here, I can certainly send it to you. You'll just want to make sure that you write down my email address and you email me that, and I'll make sure I get it out by the end of the week. So on to my last mistake that I started out at the beginning is working with a loan officer who doesn't understand the official lending rules and how to solve and overcome problems when they come up. This can be the costliest money mistake of all, because what ends up happening, my real estate friends will tell you, when things get delayed, when things get stretched out, it costs more money. So not having a loan officer that is experienced enough to have seen it and be able to solve the problems it is definitely something that's going to impact you when it comes to money out of your pocket. Want to go into a couple other things. I got some other important mortgage information I want to kind of go over with you guys. Just kind of tell you a little bit about what impacts an interest rate. Now, all these items are going to possibly have an impact on your interest rate. The biggest impact on your interest rate is going to be your credit. We'll talk about credit in a little bit more detail in a couple more slides. But as you see, the higher your credit score, the lower your interest rate is going to be. Again, as we go down below, the higher the down payment, the lower the interest rate is going to be. Different types of properties are going to have interest rates that could be higher or lower. If you're buying a condominium, it's a little bit more of a risk. And I just saw your message come in, Vince, so I lost my train of thought there. I'll answer that in just a couple minutes. But you know, the type of property and the risk that you might have, we as lenders are going to have a greater risk on a condominium because maybe it's not going to sell as quick, or maybe you're buying a multifamily property, whether it's a 2-unit or a 3-unit. Those are going to be a greater risk. So that we relegate our risk by having a slightly higher interest rate. So we're going to earn more interest while you pay it off. Now, of course, as we go back those few slides back, you can pay off some of that risk, some of that interest, and we're not necessarily getting paid as much. Now, a weird one that's out here is the loan amount. So the higher the loan amount and the lower the loan amount could mean a higher credit score. And what happens is in the industry, we look at what is the possibility of foreclosure. And so when we look at foreclosures, there's a sweet spot, and that sweet spot's between $150,000 and $275,000. So that number right there, if you find a property in between those numbers, you're going to get the best interest rate possible. Now, of course, some of the other factors could still affect your interest rate, but if you're looking at a price point in there, those are the ones that don't tend to have as many foreclosures as outside of that. And then, of course, one of the big ones, the number of years your loan's going to last. So the longer your loan is, the higher your interest rate is. Now, it's not a huge number difference, but there is a difference there. So if you look at a home and you're only going to keep the mortgage for 15 years, well, again, our risk is reduced because now we're only concerned about foreclosure for the next 15 years. Whereas if you do a 30-year mortgage, we're concerned about a lot more of that. Now, I think, Vince, this will answer your question. We're getting into credit. Credit is the biggest thing that's going to impact your ability to buy. And one of the biggest things that's out there is people have Credit Karma. Credit Karma is great. And some of these other ones, like your credit card companies, have these credit scores that pop up. Those are great in certain situations. But as you look here in this chart, there are 28 different FICO scores that are going to be used by lenders. And as a mortgage lender, we are going to use the bottom section. So we're going to use FICO 2, 5, and 4. Now, Credit Karma is going to use what's called Vantage 3.0 credit scores. So it's completely different than FICO. It's good to give you an idea of what's on your credit, what inquiries into your credit. You know, it's going to show you if there's anything that's weird on there or something that's reporting on you that is not really yours. And those are great for that. But I wouldn't be steadfast thinking that your Credit Karma credit score is going to be what we're going to pull for your credit bureau. So credit repair. And to answer your question, Vince, and the question that Vince had is, so if a person thinks they can't get a loan, do we come up with a game plan to help them get to the goal of getting into a home? And the answer is absolutely yes. So the first thing we want to do is we want to look at your credit and kind of get an idea of where you're at. So I use the example, It's like going to the doctor. You're not feeling good. The doctor's going to want to run some tests. So my test that I'm going to run is I'm going to look at your credit. And I've been doing this for going on 27 years. So I've seen a lot of credit, and figuring out what is on your credit report is the first step. So actually looking at it. Now, once we take a look at it, I have a system that I use that I can actually take a look and say, okay, how can we improve it if the credit does need improving? So it doesn't mean that you can't get into a house. You just may not be able to get into a house this month or next month. It may take you a few months to get into a house, but we will take a look and we will walk through the process together, and I will give you concrete answers on exactly what to do to help build up your credit. I have seen people go from a credit score in the low 500s, actually even under 500, to a credit score in the mid 6s or low 7s. So there are ways to do it, and we will have the ability to talk about all of that. But if nothing else, if there's nothing that I'm going to be able to do, because there are some cases where I'm not going to be able to do some stuff, but if there is something that I'm not going to be able to do, then what we want to do is we want to get you hooked up with a credit repair company, and they're going to really be able to educate you on everything that you're going to need to know. I have also just included in here, I'm going to just put in the chat this website that I have listed here, which is the MyFICO score, or myfico.com downloads. What you want to do is you want to write this down. You can certainly get a good look at exactly how things are going to impact your credit. And on the next page, we really talk about what are the steps. So if you need improving on your credit, what are the steps that we're going to do to help you improve your credit? Well, we're going to take a look at your report, and we're going to find out and make sure that you have a certain mix of credit types. You don't want to have just all car loans. You want to have some credit in there. But of course, second bullet point down, you want to have your balances lower than their limits. Old days, people used to say, close out your credit cards, don't use them anymore. Well, that's not true anymore. You don't want to close out your credit cards, especially the ones with really good histories. So if you have a credit card that you got for 10 years and you've never missed a payment and you don't owe any money on it, you got to leave it open. You want to not close out any accounts. One of the coolest things that just happened as of July is medical collections. So if you have a medical collection out there, and we can take a look at that on your credit report, if you have a medical collection out there that you have paid off or can pay off, once that is paid off or is zero balance, that automatically, by federal law, automatically drops off your credit report. And I've seen a lot of people's scores jump up. I had a customer who had cancer, still does, but is in remission. But she had a ton of medical collections, and they were all small little medical collections, but they killed her credit score. Well, she was able to pay them off, and her credit score jumped 195 points. It's phenomenal. Other things you want to make sure is with non-medical collections, those are going to be the collections with like cell phone companies, utility bills, stuff like that. It's not necessarily a good idea just to pay them off. You want to pay them off, but you want to ask them to help you out by removing them from your credit report as if they didn't exist. You don't necessarily want to pay them off without that being said. Now, there are some cases where we do have to pay them off. One of the biggest things you do not want to do is you do not want to make payment arrangements where you make them a payment every month, because every single month you make that payment, then that collection account becomes a new collection account until it reaches its 7-year period. And so it's always going to be an open and new account, and that's going to just continue to drop your credit score. Of course, always make sure that you use places like Credit Karma. Look for any errors on your credit report. If you have an ex-spouse with a collection on there, you want to make sure that it's not yours. You want to make sure that all your information is updated, that they have your correct info, whether your name is pretty common, like my name, Rob Miller. You know, I have to do this on a regular. But those are definitely things you can do to improve your score. And talking to a loan officer who's going to walk you through that is definitely something that's going to help you out. And again, we talked about it. The lower your credit score, the higher your interest rate. So again, the more it's going to cost you. So being able to improve your credit score to be able to buy is step one. But step two is also making sure we get your credit to a point where it's, you know, helpful for you. Couple other things to think about. There's a program out there, federal government program out there that's going to help people with homes. And you want to talk to your loan officer, or you want to give me a call and we can talk in greater detail about it. But the mortgage credit certificate, this is an amazing program for first-time home buyers, for veterans, and for anyone that's buying a home in a HUD designated area. Now, we would have to look up that designated area for you as you looked at homes, but most lenders are unaware of this program and don't offer it. You want to make sure that you're working with someone who's going to offer this, because this is something that's almost like free money. So it's a government program that becomes part of your tax return. Very much the same as that earned income credit that you see, or your top child credit that you see. It allows you a dollar for dollar credit for up to $2,000 every year you own the home. There's a one-time fee that you pay at closing. So that's one of the additional possible fees that you would have. There's a maximum income, and it's going to vary by the county that you're in. But here's the thing that it really does is you get a $2,000 credit. So if you're used to, or when you do your taxes, you get $1,000 back. Well, with this program, you're now going to get $3,000 back. So it's just an extra $2,000 when you do your taxes. If you owe money, let's say you owe $1,000. Well, now you only owe, now you're getting $1,000 credit or a tax refund back. So it's a phenomenal program, and you want to make sure that you're working with someone that knows the mortgage credit certificate, has been appointed to offer that, and actually does have that. So that will definitely be helpful, especially for first-time home buyers. I talked at the beginning about discount points. Now, discount points will help lower your interest rate in exchange for you paying an upfront fee. So in other words, we're going to lower your interest rate and you're going to pay a fee. When we as lenders get an interest rate for you, and let's say that interest rate is 6.5%. If we tell you that you can get, instead of 6.5%, 6%, but it's going to cost you a point. What that means to you is your interest rate for the life of your loan is going to go down to 6%, but you're going to pay 1% fee, or 1% of your loan amount. So if you have a loan amount of $100,000, you're going to pay $1,000, but you're going to save 0.5% of interest every single month, or every single year. So paying points might be an option, and working with someone that's going to talk to you about that is going to be beneficial, because it may be something worthwhile. Now, another thing that is out there is we are starting to hear about a program called a 2-1 buy down. Now, there's a lot about it, but a 2-1 buy down is effectively, again, let's use that same interest rate of 6.5%. If we take your 6.5% to start and we do the 2-1 buy down, that means we're dropping the interest rate for the first year by 2%. So in other words, 6.5 is now 4.5. So for the first year, you're going to pay 4.5%. The second year, it's going to go up 1%. So it's going to go up to 5.5%. And then, of course, the third year, it goes back up to the regular 6.5% where it's set. Now, a lot of times people are using, now you as buyers cannot use it, but remember I talked about a seller credit. Now, a seller credit can help you with the 2-1 buy down. So let's use that example. You're buying a home and you're going to offer them $200,000. Well, with the 2-1 buy down, you're going to want to make sure that you're going to offer them the $200,000, but you're also going to ask them for a seller credit to cover that. So the seller credit that there's going to cover is going to be put into an escrow account. Now, an escrow account is an account that's set aside to pay for property taxes, homeowners insurance when they come due. But with this program, we're going to take the difference between what your interest rate is in the first year of 4.5% and 6.5%. And whatever that difference is for that first year, that money, that exact amount of money is going to go into an escrow account. And then for the second year, the difference between 5.5% and 6.5%, that money is going to go into an escrow account. And let's just, for simple, easy numbers, say that between both of them, it's $7,000. Well, back to the example, you offer them $200,000. Well, instead of $200,000, you're going to offer them $207,000 and then ask them for a $7,000 credit. That $7,000 credit is going to go into an escrow account, and then it's going to help you be able to afford a lower payment for the first year, a slightly lower payment, or slightly higher, but still lower payment for the second year. And then the third year, it's going to go up to the regular number. Now, that escrow account is always your money. So if you do sell or you do refinance because interest rates go down or something happens, and whatever money is in there in that 2-year period, that would be coming back to you in what they call a principal reduction. So in other words, let's say you used it for a year and we refinanced you and you got a lower interest rate anyways. And let's say now your interest rate is 4%. Well, we still have $3,000 sitting in that escrow account. We're going to take that and subtract it from what you owe on your mortgage when we do a refinance or when you sell. So that is a 2-1 buy down. It definitely is an option that's available for people to help, especially this time when interest rates are higher. It's always good to look at different options that you have and talking to someone that really knows all those different options. On this page here, it really is just talking about the definitions of what makes up a mortgage payment. Now, there's going to be 4 to 6 to 7 different parts of your mortgage payment. Of course, your principal, that's the amount of money you borrowed from us. And the interest is the amount of money that you're paying on the money that you borrowed from us for the privilege to borrow the money. Of course, every home is going to have required home insurance, and every house is going to have property taxes. So you're going to want to make sure that you pay those. So potentially those would be escrowed in to pay. If you're not putting 20% down on the home, you could have mortgage insurance. Some cases, mortgage insurance is a good idea. In some cases, it could be a tax deduction for you. So if you're not putting 20% down, you're gonna have that. If you're putting 20% down, you're not gonna have that. It's not necessarily a bad thing in some cases. And I actually ran into this a couple of weeks ago when I talked to someone. They had enough money to put 20% down. Well, I recommended to them that they put 19.5% down, and then they pay the mortgage insurance until it goes away, which is once they reach 20%. So in their situation, they paid the mortgage insurance for 6 months, which accounted for approximately $350 that they were going to pay. But instead of that high, they had a slightly lower interest rate because we have an insurance policy that will help pay that. That's what mortgage insurance is. Now, if you're buying a property in a condominium or an association, there could be condo dues and association dues. If we do determine that your house is in a floodplain, you may have to have flood insurance. But those are really the parts that make up a mortgage payment. Just a few more things, a few more slides, and we're almost done, guys. I have here just a little bit of information. Please feel free to reach out to me. I have look at me, look at my reviews, check out my reviews online. If you just search for Mad City Home Loans or Rob Miller Provisor, you'll find me. I certainly love to talk to you. You know, when we get to this page here, it just asks what happens in the first call. Well, the first thing we're going to do is we're going to want to learn about your payment goals. So what are you looking to spend? What can you really afford? So we're going to talk about your income. We're going to talk about your debts. We're going to talk about your credit. This is not doing a pre-approval. Now, of course, we can go to that step, but we're not going to do that necessarily initially. Once we get this kind of figured out, we'll talk about it. And then I can do some hand math, and then we can talk about the different loan options that are available for you. But that's what really happens on the first call. Top 5 reasons to talk to me. Of course, you have questions that didn't get answered. And Vince, I saw your next message pop up, and I'll get to that in a minute. You want to understand all your personal mortgage options. So you want to have that introductory call. You have some concerns about your credit and you want some answers. You want to do a formal pre-approval, or you talk to someone else and they told you maybe you couldn't buy, or maybe you could, but this is the only thing you can do. And you just had some clarifying questions. You just wanted to clarify a few things. So at this point, you know, if you got any questions for me, anyone, please certainly ask them in the chat. So let me read your message here, Vince. So the first part of your question is if they get pre-approved and it's only for $150,000, but they want to buy a $250,000 home, do they have a way or an option and for a second mortgage? Potentially, yes. So if they're approved and they've gone through the steps of the pre-approval, providing income documentation, credit, asset documentation, there are options for that. If they've only been approved for $150,000, then they have, so again, let me try to word this a little differently. If they've only been approved up to $150,000, they can't go any higher than that for whatever reason, then even doing a second mortgage is not going to be an option for them. Now, there are some programs out there, and I talked a little bit about down payment assistance. I talked a little bit about grant money that is available for people. And there are programs out there that I can certainly help search and find out if anyone qualifies for, that can help boost their buying power. So if they are, you know, at $150,000, probably not going to get $100,000 in grant money. Possibly you could get up to $50,000, depending on the situation. That'd be something we would want to have a chat about. And of course, schedule a time with me. And then your second part of your question is, if they make $50,000 a year, can they buy a house that costs $350,000, I'm assuming, with good credit? So it's really looking at their entire debt picture. So if they make $50,000 a year, there's a chance that they could afford a $350,000 home. If they don't have a lot of other debt out there. And when I'm talking about debt, I'm talking about not just what they make monthly payments on, but I'm talking about stuff that is going to report on credit. So if they have car loans, if they have credit cards, if they have personal loans, one of the biggest things that people don't ever understand is, well, hey, I have student loans, but I don't have to make a payment on it. Well, we have to include a payment on it. So depending on the size of the student loans, even though they may not have a payment, we do have to include something in there. Now, there are a couple programs out there that, might work for them. And that's why talking to someone who really knows all the programs is going to be the best solution for you. So please feel free to give me a call. And I would certainly love to just chat. Any other questions that anyone has? All right. All right. Sherry, I know you did send me a message when you signed up for the webinar about the 2-1 buy down, and I talked a little bit about it. Hopefully that gave you some answers. But if you have any additional questions or answers, please certainly feel free to shoot me an email or give me a call. I'd certainly love to talk to you. I think I know you too, outside of this. Same thing with you, Vince. But nonetheless, my last slide for you, and then we can go to the Packer game. I appreciate all your time. Please feel free to click on this QR code, get my contact information, give me a call, shoot me a message if you have any questions. I gladly answer any of them. No pressure whatsoever. I just want to make sure that you know exactly what is going on, because knowing is power, and it's going to be a way to save you money. And yes, Vince, I do know you from outside of this as well. So I hope everyone has a great evening. If no one has any other questions, hope everyone enjoys the game tonight. I know it started a little while ago, but please feel free to have a good evening. All right, bye all.